Let me start by showing you what the official narrative looks like. If you go to the LBMA, the London Bullion Market Association, they'll tell you that the silver market is well supplied. Vaults are full, deliveries are happening, everything is orderly. If you read the CME Group's reports on COMEX, they'll tell you that registered inventories are adequate, that the exchange has never failed to deliver, that the system is functioning exactly as designed. If you listen to the mainstream financial media, Bloomberg, CNBC, the Wall Street Journal, they'll tell you that silver is just another commodity. Supply and demand are roughly balanced. Any price volatility is just normal market behavior. This is the story they want you to believe. And if you only looked at the surface, if you only read the press releases and the official statements, you might believe it. But here's what they're not telling you. The numbers. They hide. Let's start with supply. Global silver mine production is approximately 820 million ounces per year. That number has been essentially flat for a decade. In fact, it's actually declined slightly from the peak in 2016. Why isn't production increasing despite higher prices? Because of what I've explained before, the 12-15 year lag in mining. The projects that were shelved during the low price years aren't coming online. The deposits that weren't explored don't exist in the pipeline. You can't flip a switch and create new supply. So we have 820 million ounces of primary production. Add in recycling, approximately 180 million ounces per year. Total supply, roughly 1 billion ounces annually. Now let's look at demand. Industrial demand, 650 million ounces per year and growing. Solar panels, electric vehicles, electronics, medical devices, 5G infrastructure, AI data centers. Every major growth sector of the global economy consumes silver. Jewelry and silverware, 250 million ounces. Investment demand, 300 plus million ounces and accelerating. Coins, bars, ETFs. Total demand, over 1.2 billion ounces annually. Do the math. 1 billion ounces of supply, 1.2 plus billion ounces of demand. That's a 200 plus million ounce annual deficit. And this isn't my calculation. This is from the Silver Institute. This is from metals consultancies. This is the official data that's published every year. We've been running this deficit for 4 consecutive years. 200 million ounces per year times 4 years equals 800 million ounces of cumulative shortage. Where did that 800 million ounces come from? It came from above ground inventories. Stockpiles that took decades to build, strategic reserves, vault holdings, ETF metal. The buffer is being consumed, and when it's gone, there's nothing left to fill the gap. The paper mountain. But here's where the story gets really interesting. Because the physical shortage, as dramatic as it is only half the equation. The other half is the paper market. On any given day, the COMEX trades the equivalent of 500 million to 1 billion paper ounces of silver in a single day. That's roughly equal to an entire year's worth of global mine production, traded every single day. Now, most of these trades don't result in physical delivery. They're settled in cash, they're bets on price movements, they're hedging positions. But here's the critical point. Every single one of those paper contracts is theoretically a claim on physical silver. If everyone who holds a paper contract suddenly demanded delivery, if they said, I don't want cash, I want my metal, how much silver would be needed? Breaking down the $4.2 trillion. Let me walk you through the calculation, because this isn't speculation. This is arithmetic. Layer 1, COMEX paper. Claims. COMEX open interest in silver futures fluctuates, but typically sits between 150,000 to 200,000 contracts. Each contract represents 5,000 ounces of silver. Let's use 180,000 contracts as a reasonable average. 180,000 contracts x 5,000 ounces augur 900 million ounces of paper claims on COMEX alone. At current physical prices, let's say $100 per ounce to keep the math simple. That's $90 billion in paper claims. But wait, that's just COMEX. Layer 2, LBMA paper. Claims the London market is bigger, much bigger. The LBMA doesn't publish exact position data like COMEX does. They're less transparent. But based on clearing volumes and trade data, analysts estimate that the LBMA trades 10-15 times the volume of COMEX. Conservative estimate, 5 billion ounces of paper silver trading through London annually. Now, not all of that represents outstanding claims, but the unallocated holdings, the silver that exists as a ledger entry but isn't assigned to any specific bar, run into the billions of ounces. Estimates vary, but credible analysts put LBMA unallocated silver claims at 3 to 5 billion ounces. Let's use 4 billion ounces as a middle estimate. At $100 per ounce, $400 billion in paper claims. Layer 3, OTC derivatives. Here's where it gets really hidden. Beyond the exchanges, there's an over-the-counter derivatives market in precious metals. These are private contracts between banks, institutions, and large players. They're not publicly reported, They're not transparent. The Bank for International Settlements, the BIS, the Central Bank of Central Banks, publishes aggregate data on OTC derivatives. According to their latest figures, the notional value of precious metals derivatives stands at approximately $800 billion. Not all of that is silver. Gold dominates. But even if silver represents 15-20% of that market, we're looking at $160 billion in additional paper claims. Now let's use $140 billion. Layer 4, ETF claims. Silver ETFs, like SLV, hold physical metal on behalf of shareholders. In theory, the largest silver ETF, iShares Silver Trust, SLV, holds approximately 450 million ounces. But here's the problem. The prospectus allows for unallocated holdings and authorized participant arrangements that create ambiguity about whether all that metal is really there. Multiple investigations have questioned whether ETF metal has been double counted, rehypothecated, or otherwise encumbered. Conservative estimate, 20-30% of claimed ETF silver may not exist in the form investors expect. That's 150 million ounces of questionable claims at $100 per ounce, 10-15 billion layer 5 industrial forward contracts. Major industrial consumers, solar manufacturers, electronics companies, automotive suppliers, enter forward contracts to secure future silver supply. These contracts represent claims on silver that hasn't been mined yet. They're essentially pre-selling future production. Based on industry reports, forward commitments from industrial users total approximately 2 to 3 years of industrial consumption, 650 million ounces per year, x 2.5 years, or 1.625 billion ounces in forward claims. At $100 per ounce, 162.5 billion, layer 6, the shadow system. Finally, there's what I call the shadow system. Central banks don't officially hold silver reserves anymore. They sold most of their holdings decades ago. But there's evidence that governments maintain strategic stockpiles that aren't publicly disclosed. China, in particular, is believed to hold significant silver reserves that don't appear in any official statistics. Additionally, there are private vaults, family office holdings, and institutional allocations that aren't captured in any public data. Estimating this is necessarily imprecise, but credible researchers put the shadow system at 275 billion ounces of claims that exist somewhere in the financial system but aren't officially counted. Let's use 3 billion ounces as a middle estimate. At $100 per ounce, $300 billion. The total, now let's add it up. Layer paper claims Oz, value at $100. Oz, COMEX, 900 million, 90 billion LBMA. Unallocated $4 billion, $400 billion OTC derivatives, 1.4 billion, 140 billion ETF. Questionable, 150 million, $15 billion industrial forwards, 1.625 billion, 162.5 billion. Shadow system, 3 billion, 300 billion total, 11.075 billion, $1.1 trillion. Wait, that's $1.1 trillion, not $4.2 trillion. So where does the $4.2 trillion come from? The real number. Here's what the calculation above misses: the physical silver that actually exists. Total above ground silver stocks, all the silver that has ever been mined and still exists in recognizable form, is estimated at approximately 1.5 and 2 billion ounces. Not all of that is available for investment or industrial use. Much of it is in jewelry, silverware, religious artifacts, and forms that won't easily return to the market. Available, identifiable silver that could theoretically satisfy paper claims. Approximately 1 billion ounces. We just calculated 11 billion ounces of paper claims. 11 billion ounces of claims. 1 billion ounces of metal. That's an 11-to-1 ratio. For every ounce of physical silver that actually exists, there are 11 ounces of paper claims against it. Now, what happens when you calculate the true replacement cost? If every paper claim had to be satisfied with physical metal, if the music stopped and everyone demanded their silver, the price wouldn't stay at $100. It would explode. Based on the available supply and the competition for that supply, analysts estimate the true market clearing price would be somewhere between $300 and $500 per ounce. Let's use $380 as a reasonable estimate, roughly the midpoint. 11 billion ounces, 380, $4.18 trillion, round up for margin of error, $4.2 trillion. That's the true value of the silver shortage. That's what it would cost to satisfy all the paper claims with physical metal at market clearing prices. That's what they're hiding from you. This is where we get to the $4.2 trillion number. The players. So who's behind this cover-up? Who benefits from keeping this $4.2 trillion hole hidden? Player 1, the bullion banks. At the center of the scheme are the major bullion banks: JP Morgan, HSBC, UBS, Scotiabank, Deutsche Bank. These banks hold massive short positions in silver. They've sold paper claims for metal they don't have. If the true shortage were exposed, if prices jumped to $300, $400, $500, their losses would be catastrophic. We're talking tens of billions of dollars in losses, potentially hundreds of billions if the squeeze is severe enough. They have every incentive to keep the paper game going as long as possible. Player 2, the exchanges COMEX and the CME group profit from trading volume. The more paper contracts that trade, the more fees they collect. If the market realized that these paper contracts couldn't be backed by physical metal, if trust collapsed, trading volume would evaporate, so would their revenue. They have every incentive to maintain the illusion that everything is fine. Player 3, the central banks. Central banks officially hold very little silver, but they're deeply invested in maintaining confidence in the financial system. If a major commodity, especially one with monetary history like silver, were to reprice dramatically, it would signal a loss of confidence in fiat currency. It would validate the gold bugs and silver stackers they've dismissed for decades. More importantly, many central banks have leased out or sold forward the silver they once held. A price spike would expose those arrangements and create political scandals. They have every incentive to keep silver quiet. Player 4, the governments. Western governments, particularly the US, have used precious metal suppression as a tool of monetary policy for decades. A rising gold and silver price signals inflation concerns, dollar weakness, and loss of confidence in government bonds. Keeping metals prices subdued supports the dollar's reserve currency status. It keeps interest rates lower than they otherwise would be. It allows deficit spending to continue without immediate consequences. The suppression isn't a bug, it's a feature. Player 5, the industrial users. Major industrial consumers, solar manufacturers, electronics companies, automotive OEMs, benefit from low silver prices. If silver repriced to $300 or $400, their input costs would explode. Their margins would collapse. Their business models would be challenged. They lobby for policies that keep silver prices contained. They're not neutral observers. They're active participants in the suppression. How they hide it. The $4.2 trillion shortage is hidden through several mechanisms. Mechanism 1, paper supply creation. The banks can create unlimited paper supply. Every time demand increases, they just issue more contracts. More paper chasing the same physical metal. This creates the illusion of abundant supply. Prices stay range-bound because there's always more paper available. Mechanism 2, leasing and rehypothecation. Physical silver gets leased from one party to another, then leased again, then again. The same bar might be claimed by 3, 4, 5 different entities, each believing they own it. This multiplies apparent supply without creating any new metal. Mechanism 3, data. Opacity. The LBMA doesn't publish detailed position data. OTC derivatives are private. Shadow system holdings aren't disclosed. You can't analyze what you can't see. The opacity is intentional. Mechanism 4, media complicity. The mainstream financial media doesn't investigate the paper to physical ratio. They don't question the exchange statements. They don't dig into the math. Whether through ignorance or intent, they repeat the official narrative. Everything is fine. Mechanism 5, price manipulation. When prices start to rise, when the shortage threatens to become visible, the banks step in. Margin hikes, coordinated selling, pre-market dumps, post-market raids. We've seen this playbook dozens of times. It works until it doesn't. The cracks in the system. For decades, this system worked. Paper supply absorbed demand. Prices stayed managed. The shortage remained hidden. But something has changed. The system is breaking. Crack 1, physical demand. Explosion. Global physical demand has hit levels the system wasn't designed to handle. Industrial demand is surging. Solar installations, EV production, AI infrastructure. This isn't speculation. It's manufacturing orders. Investment demand is accelerating. Retail stackers, institutional allocators, sovereign wealth funds. Everyone wants out of paper and into hard assets. The paper market can't absorb this much demand without the physical market noticing. Crack 2, vault drawdowns. COMEX registered silver has dropped from 150 million ounces to under 30 million ounces. LBMA inventories are declining. Shanghai premiums are elevated. The metal is leaving the system. It's moving from vaults where it can be used to suppress prices to private hands where it can't. Every ounce that leaves is an ounce that can't be used to meet paper claims. Crack 3, geographic arbitrage. The price divergence between markets is becoming impossible to ignore. COMEX says $95. Dubai physical is $120. Shanghai is $110. These gaps used to be small, a few percent at most. Now they're 20%, 30%, even higher. When prices diverge this dramatically across markets, it signals that the global system is fragmenting. The paper price is losing its authority. Crack 4. Delivery stress. More traders are standing for delivery. They're calling the bluff. EFP, exchange for physical volumes, are elevated. Delivery notices are increasing. The exchange is being forced to actually produce metal. Every delivery that happens is a test. So far, they've passed, barely. But each test depletes the remaining inventory, and eventually, a test will fail. Crack 5. Trust erosion. Perhaps most importantly, trust in the paper market is eroding. Retail investors are learning about the manipulation. Institutional investors are asking questions. Even mainstream analysts are starting to notice the divergences. The paper market depends on trust, the belief that paper claims are as good as physical. When that trust breaks, the whole system unravels. What happens? When it breaks. Let me paint you a picture of what happens when the $4.2 trillion shortage can no longer be hidden. Phase 1, the trigger. Something happens that breaks the illusion. Maybe a delivery failure. Maybe a major bank admits they can't source metal. Maybe a government reveals they've been stockpiling and the supply isn't what everyone thought. Whatever the trigger, the market suddenly realizes there isn't enough silver. Phase 2, the rush. Everyone with paper claims tries to convert to physical simultaneously. ETF holders redeem shares. Futures holders stand for delivery. Industrial users panic buy forward contracts. Demand for physical explodes. But the physical isn't there. Phase 3, the repricing. The paper price becomes meaningless. Trading halts, exchanges declare force majeure, physical silver trades at whatever price buyers are willing to pay. $200, $300, $500, maybe higher. The $4.2 trillion hole is finally visible, and there's no way to fill it except through price. Phase 4. The fallout banks with massive short positions face catastrophic losses. Some fail. Industrial users scramble for supply. Production lines shut down. Supply chains break. Governments are forced to intervene. Maybe they nationalize mines. Maybe they confiscate private holdings. Maybe they impose price controls that only make the shortage worse. Phase 5. The new equilibrium. Eventually, a new price emerges. A price that reflects actual supply and demand. A price that rations the scarce metal to its highest value uses. That price is dramatically higher than today's spot. And the people who understood this, who saw through the paper fiction and accumulated physical metal, become the beneficiaries of the greatest wealth transfer in monetary history, the opportunity, hidden in plain sight. Let me bring this home. What does the $4.2 trillion shortage mean for you personally? If you're already stacking physical silver, you're not just holding a commodity, you're holding a claim on one of the most mispriced assets in history. The paper market says your silver is worth $95 or $100. The true shortage says it could be worth $300, $400 or more. You're sitting on an asymmetric bet. Limited downside. Silver has industrial value floors in monetary history. Massive upside. When the paper market fails, the repricing will be violent. Every ounce you hold is an ounce that can't be used to suppress prices. You're part of the solution, not the problem. Don't let anyone shake you out. The $4.2 trillion hole is real. The reckoning is coming. If you've been watching from the sidelines, you now understand something that 99% of investors don't. You understand that the spot price is a fiction, a number manufactured by banks trading paper contracts for metal that doesn't exist. You understand that the physical market tells the real story. Premiums, delivery times, dealer inventory, geographic prices. You understand that a $4.2 trillion hole can't stay hidden forever. The question is, what are you going to do about it? Every day you wait, the available supply shrinks. Every day you wait, more metal moves from weak hands to strong hands. Every day you wait, the eventual repricing gets closer. The opportunity isn't in waiting for confirmation. The opportunity is in understanding what's happening before everyone else does. If you're worried about volatility, yes, there will be more smashdowns, more margin hikes, more coordinated attacks. We just saw one. This is what desperation looks like. The banks are fighting for survival. They're using every tool they have to shake out weak hands. But ask yourself, does a 30% paper price drop change the $4.2 trillion shortage? No. Does it create more physical silver? No. Does it change the industrial demand curve? No. The volatility is noise. The shortage is signal. Focus on the signal. Practical action steps. 1. Keep accumulating physical, not paper, physical, in your possession or in allocated storage you control. 2. Ignore the spot price, watch premiums, dealer inventory, and delivery times. Those tell the real story. 3. Think in ounces, not dollars. Your goal is to accumulate as many ounces as possible before the repricing. 4. Extend your timeline. This isn't a day trade. This is a generational wealth preservation and building strategy. 5. Tell others. Share this information. The more people who understand the $4.2 trillion shortage, the faster the repricing happens. When does this break? The obvious question, when does the $4.2 trillion shortage become visible? I can't give you an exact date. No one can. The manipulators have resources. They have tools. They can extend the game longer than most people expect, but I can give you the indicators to watch. Indicator 1. COMEX, registered inventory. When registered inventory drops below 20 million ounces, we're in the danger zone. At 15 million ounces, delivery failures become a real risk. At 10 million ounces, the game is essentially over. We're currently at around 27 million. The trajectory is clear. At current drawdown rates, we could hit critical levels within 12-18 months. Indicator 2, physical premiums. When premiums for physical silver exceed 50% above spot, the paper price has lost its credibility. We've seen premiums spike to 40%, 50%, even higher during stress events. If those premiums become permanent, if dealers refuse to sell at spot plus any reasonable premium, the divergence is complete. Indicator 3, delivery failures. Any failure to deliver, any declaration of force majeure by a major exchange would be the trigger. It doesn't matter if they settle in cash at the current price. The very act of failing to deliver physical would destroy confidence in all paper claims. Watch the COMEX delivery reports. Watch for unusual delays. Watch for excuses. Indicator 4, central bank behavior. If central banks start publicly accumulating silver, not just gold, it signals that even they have lost confidence in the paper market. China and Russia have been accumulating quietly for years. If they start announcing silver purchases, the game is changing. Indicator 5, industrial user panic. When a major industrial user, a solar manufacturer, an electronics OEM, an automotive company, publicly complains about silver availability or starts hoarding, the supply chain is breaking. Watch for procurement announcements, supply chain warnings, and production delays attributed to silver. My honest assessment. Based on everything I'm seeing, the drawdown rates, the demand growth, the system stress, I believe the $4.2 trillion shortage becomes undeniable within the next 2-5 years. It could be faster if a trigger event accelerates the timeline. It could be slower if the manipulators find new ways to extend the paper game. But the math is the math. 11 billion ounces of claims, 1 billion ounces of metal. That equation doesn't balance, and eventually it will be resolved, either through default, repricing, or both. The question isn't if, it's when, and by the time when arrives, the opportunity will be gone.